Brahman Gill with episode 5 of the 10,000 Trade Show. This show is all about mastering trading and creating excellence through deliberate practice and analysis of 10,000 trade setups. In this episode, we will take a look at the concept of inefficient market moves. Inefficient market moves are moves that happen very fast, and these could be a result of a news event or when an official comes out and says something that moves the market. As always, we'll take a look at how to identify this trade setup, where to put our stop loss, where the entry and exit needs to be, and how do we make money from this setup. So let's go on over to the charts now.
This type of setup tends to happen right after a news event. And what we find is that after news has come out, price will move very, very quickly, creating what's called an inefficient move. So this here is an example of an inefficient move. This is New Zealand US dollar 1 hour chart. Last week, Reserve Bank of New Zealand cut their interest rate. And when a central bank cuts their interest rate, price for that currency generally tends to drop. And this is exactly the behavior we saw in New Zealand dollar. Once your big candle has formed, you want to give the trade some time to settle in. You don't want to just trade against the momentum in price. You want to wait for the selling to finish essentially, and you're looking for buyers to come into the market. And the way you can tell that the buyers have come into the market is by looking at this big engulfing candle. So these candles that you see, the green candles that you have here, are very, very small candles. There's really no substance in these candles. So we are looking for a nice big engulfing candle. Once we get this candle, we can take a buy entry. And we are looking for this move to get retraced. So basically the price, we're looking for price to move all the way back into this level. So you would take your entry here, put your stop loss here, and your target will be a few pips ahead of this pin right here. And if you use Fibonacci for your trading, you can draw your Fibonacci, and you will notice that this is also the 78.9 retracement level. This level that the price goes back to right here is called the breaking point. So the way this trade sets up is you look for a big price move, whether that's up or down. In this case, it's a price drop. You wait for the price to settle down, and this could take 15 minutes, it could take half an hour, or in this case, it could take a few hours. And then you're looking for big engulfing candles, something that suggests that the buyers have come back into the market and you want to trade in that direction. Stop loss goes behind the lowest level that the price has traded, which is this pin here. And our take profit would be just before we get into this pin here, which is called the breaking point. Sometimes the trade will come up here and reverse because fundamentally this is weak. Once the interest rates are cut, you do expect the currency to depreciate in value, which is what's happening here. Other times you will see that the price will come all the way to the top and may even go up higher. However, the trade is done once the price comes to the breaking point. So this is a really nice, easy setup to take.
Hope you enjoyed that trade setup. If you like this video, please feel free to share it with your friends and make sure you subscribe to the show so you get the latest episodes. Thank you so much for joining me today, and stay tuned for tomorrow's episode because we will be back with another great trade setup.